Today we're going over some big LLC mistakes that could cost you everything in a lawsuit. If you've set up an LLC, you probably did it to protect your assets. But there are some key pitfalls to avoid so you don't lose everything. LLC mistake number 1, mixing business and personal assets. For any business owner, maintaining a clear divide between personal and business finances is essential. Setting up a dedicated business checking account and business credit card not only simplifies financial tracking and tax filing, but it also safeguards you in the event of an IRS audit. For limited liability companies, this separation is even more critical. Blending personal and business finances can erode liability protection, putting your personal assets at risk. If your business is ever sued, this blurring of lines, known as piercing the corporate veil, can make it easier for creditors to reach into your personal assets. I once worked on a case where a client was injured at a bar. During litigation, we uncovered that the bar owners regularly use their business account for personal expenses. This commingling weakened their legal protection, and we argued it justified piercing the corporate veil. The takeaway: keep your finances clearly separated. Use dedicated business accounts and credit cards for all business expenses. If you do mix up a transaction, correct it promptly by documenting the error and reimbursing the account. Occasional mistakes can happen, but they should be the exception, not the rule. LLC mistake number 2, mixing finances across multiple businesses. Entrepreneurs often see opportunity everywhere, which can quickly lead to managing 2, 3, or even more businesses at once. While it's exciting to expand, be cautious combining finances across your ventures because it can open the door to personal liability for all your businesses, undermining the protection your LLC should provide. Imagine one of your businesses hits hard times or faces a lawsuit. If you've blurred the financial lines between multiple businesses, creditors could pursue assets from your other ventures. Operating several businesses under one LLC is like juggling fire. It's dangerous and can quickly burn through your liability protection. I once represented a client who was injured at a motel. The owners operated 3 motels and grouped them under one LLC. In court, this backfired. Because their finances were entangled, we gained access to the assets of all 3 motels, exposing them to significant risk. The solution? Create a separate LLC for each business and keep each one's finances strictly separate. This way, the risks of one business don't spill over onto the others. And of course, slip-ups happen. If you use the wrong business card by mistake, just document the mix-up, issue a reimbursement, and keep records to show you're following proper corporate practices. LLC mistake number 3, acting recklessly or fraudulently. This should go without saying, but it's worth emphasizing. Engaging in illegal or fraudulent activities not only damages your reputation, but can also strip away your LLC's liability protections. For instance, imagine you're eager to secure a business loan and decide to exaggerate your company's financials. If you later default on the loan and the lender uncovers the falsehood, they could hold you personally responsible for repayment, even without a personal guarantee on the loan. Fraud can also open up a legal loophole where creditors can use it to pierce the protection of the LLC. The solution? Stay on the right side of the law and operate with integrity. Upholding ethical practices safeguards both your business and personal assets. Think of your reputation like a crystal vase. It takes care to polish and protect, but a single slip can shatter it. LLC mistake number 4, skimping on startup capital. Starting a business can be costly. There are initial expenses like leasing space, purchasing liability insurance, hiring staff, stocking up on inventory and equipment. One crucial mistake is undercapitalizing or starting the business with not enough money to cover foreseeable expenses and obligations. In other words, your business needs enough capital, whether it's money you and your partners invest or loans from lenders or banks to fuel its growth. Running a business on a shoestring budget is like trying to drive a car with an empty gas tank. You won't get very far, and you might risk your personal finances in the process. There's no universal amount that every business needs to be well capitalized. The required capital depends on your industry, operations, and level of risk. For example, let's say you're launching a business that realistically requires $1 million to start, but you only have $100,000 to invest. If things go south, courts could argue you didn't adequately capitalize the business and might hold you personally liable for outstanding debts. The solution: collaborate with an accountant or financial advisor to plan your projected revenues and expenses and research similar businesses in your field. Make sure you have enough funds to keep your business running smoothly. Cutting corners could lead to bigger financial risks. The next mistake is not updating your operating agreement. An operating agreement acts like a roadmap for your LLC, detailing who controls finances, makes key decisions, and how profits and losses are split among members, if there's more than one. While not every state requires one, having an operating agreement is crucial for clarity and protection. As your business grows, it's important to keep your operating agreement updated. Let's say you start your LLC with one partner, and later you bring on a third member. If you don't revise the agreement, you're missing critical information about how profits will be shared, who has voting power, and who's responsible for specific roles. Similarly, if an LLC member retires, or if your partner decides to change the profit split, these updates need to be reflected in your agreement. Without these risks, you risk legal conflicts and personal liability. For example, if your agreement is outdated and a dispute comes up, courts may decide you're personally liable for the LLC's debts, potentially putting your personal assets at risk. The fix: make it routine to review and update your operating agreement as your LLC evolves. Think of it like updating a navigating app. You wouldn't want to follow directions using a map from years ago. Staying current keeps everyone on the same page and helps protect you from unnecessary legal issues. If you're a business owner and a parent and you liked this video, you should watch my video on the 3 secrets to hiring your kids and save thousands in taxes. I'll link it here.